The standard advice says if you didn't start investing in your early 20s, you've missed the window for a comfortable retirement. But the math for a 45-year-old is different because the objectives are different. You are entering your peak earning years with a professional skill set built over 2 decades. While a 20-year-old relies on time, you rely on the intensity of your income and the ability to monetize existing expertise. Compressing a 40-year career into 10 years requires a transition from casual saving to a concentrated 5-part strategy. When your timeline is short, deliberate financial intensity becomes your most valuable asset. To reach a $1.5 million target, we combine 3 specific streams. Directing $27,000 a year into index funds yields $430,000. Adding $12,000 a year in side income contributes another $190,000. The remaining gap is closed by the equity and appreciation of a single rental property. This outcome is the result of systematic execution across 5 specific areas of your financial life. We start with the offense budget. Defensive budgeting focuses on small, daily sacrifices that have a limited impact on your net worth. An offense budget focuses on the structural architecture of your life to maximize the capital you can deploy toward wealth. This checklist represents the 4 categories that consume the majority of your income. By optimizing these high-leverage areas rather than small daily habits, you create immediate, significant cash flow. One decision, like moving to a slightly more affordable area or moving from 2 car payments to 1, can recover $1,900 a month. These are one-time structural shifts that pay dividends every month without requiring ongoing willpower. We then shift to income expansion. Somewhere in your 20 years of experience is a skill that a small business or individual would pay for directly. This is an asset your employer currently captures the full value of. The goal is high-leverage work, like consulting or a specialized freelance service that generates $1,000 a month. Low-scale gig work, like ride-sharing, consumes too much time for too little return on your existing expertise. Combining these structural savings with new income can move a household savings rate from 10% to over 40%. At that level, the 10-year retirement window moves from a possibility to a conservative projection. The order in which you deposit your money determines the final size of your portfolio. Following a specific sequence ensures your money is working with the highest possible efficiency. First, capture every dollar of your employer retirement match. This is a guaranteed return on investment. Next, fill a 3 to 6 month emergency fund in a high-yield savings account. This buffer prevents selling investments during a temporary downturn. Then, maximize your tax-advantaged accounts. Utilizing a 401k or HSA saves thousands in taxes annually, reinvested to compound over the decade. Only after these accounts are optimized do you funnel remaining capital into a standard brokerage account. Within those accounts, we use a low-cost, diversified allocation. You should expect a 30% market correction at some point in the next 10 years. By deciding today that you will not sell during a dip, you protect your portfolio from the losses that occur when investors act on emotion. Removing emotion through automation and a strict sequence of operations is what allows the math to work over the long term. To reach financial independence in 10 years, you need one asymmetric asset, an investment that offers tax benefits, forced savings, and the potential for returns that exceed the broad market average. Real estate is the most common vehicle for this. Strategies like house hacking or purchasing rental properties in secondary markets allow you to build equity through mortgage paydown while the property appreciates. Consider this case of a nurse in Texas. She purchased a duplex for $182,000. Over a decade, the tenants paid down $61,000 of the mortgage, while the property's market value grew to $280,000. If direct property management isn't an option, you can achieve similar real estate exposure through publicly traded real estate investment trusts or business development companies. Adding one asset with these characteristics bridges the gap between standard market returns and the accelerated 10-year goal. We must also implement a layer of protection. Because you have a shorter window to recover, a single medical or legal event could derail the entire plan. This includes adequate term life insurance, long-term disability coverage, and a foundational estate plan. These aren't investments. They are the safeguards for the assets you are building. Without these protections, a sudden emergency can freeze your accounts or force you to drain your savings, effectively ending your retirement journey. The final step is external accountability. People pursuing long-term goals in isolation fail at much higher rates than those working within a community. Identify one person who shares your commitment to financial improvement. Arrange a monthly 30-minute check-in to review your numbers and progress. Insurance protects your capital from catastrophe, while accountability protects your consistency from the fatigue of a 10-year journey. This 10-year journey moves through distinct phases: architecture in year 1, building momentum in years 2 and 3, acceleration through year 7, and a final transition to preservation in the remaining years. Your specific retirement target is based on the 4% rule. This chart shows how different portfolio sizes translate to annual income. A $1.5 million portfolio, for example, supports $60,000 in annual withdrawals. A 1-year delay in starting this plan has a measurable cost. Between missed employer matches and the lost compounding, on a $500,000 portfolio, waiting 12 months can reduce your final net worth by nearly $80,000. Take one irreversible action before you close this video. Increase your retirement contribution, move to a high-yield account, or text an accountability partner. This single action shifts the plan from a theoretical concept into a functioning portfolio. To maximize the efficiency of your new strategy, watch the next video to learn how to structure your withdrawals to minimize tax drag.